Nyas Securities video. This is Atish, and in this video, I'm going to talk about the risk management strategies for investment. We all have our investments, and there is always risk associated with it. And in this video, we're going to understand the different risks and how we can manage them. So, first and foremost, the first is avoid. One must totally avoid the investment products if one does not understand the underlying business, even if that means giving up on the opportunity on benefit of that investment. So if you don't understand the business, if you don't understand the process, it generates cash flow, the process it generates revenue. There is no point in being in that business. For example, recently there was a trend of Bitcoin was giving good returns over time. If you don't understand personally the how Bitcoin is growing, then is no point of investing in Bitcoin. No matter even if you know that you're going to lose an opportunity, it's better to avoid than to make it a very highly risky. And the second is diamonds. I personally don't invest in diamonds because I don't understand the business. You can at least go up to commodities for up to gold, but not in the case of diamonds. The second is hedging your positions. So this is one of the most used risk mitigation strategy, not just by retail investors, but also hedge funds and institutional investors. So what does hedging means? Hedging means taking a counter position on your set investment. Like for example, if you are having some shares of Reliance, and if you think that due to some risk factors the shares of the Reliance may fall, then you can go short in Reliance futures. So when you go short in futures, you are taking a counter position against your cash market. So this becomes a risk mitigation strategy. Again, the next method is hedging equity with gold. As you know that if equity rises, the gold falls. If the equity falls, the gold rises. Similarly, if there's a risk of equity to fall, your gold can rise up, thereby balancing your portfolio. The third is hedging interest rate with bonds. If you have an FD and if you feel the interest rates are going down, similarly you can shift some of your money from fixed deposit to bonds where they are again inversely proportional to each other. If the interest rates will fall, the rates of bonds will rise. The next is foreign investment with currency. If you are investing in a US company, it is always good to stay invested in also currency, because what if rupee appreciates further, you may lose on opportunity or you may lose on your capital. The third and the most important, not just for institutional but also for retail, especially the retail, is diversification. Hedging will only work if one has the superior knowledge. And if you have no knowledge about how to hedge your position, then it is diversifying is one of the best positions to mitigate your risk. Those who do not know everything, a prudent approach would be diversify across various assets. And diversification means diversifying your money into different assets, making sure that all your eggs are not in the same basket. And if a particular sector in that basket even falls, your overall portfolio does not get disturbed. This is one of the main methods of risk mitigating strategies. And here I would like to talk about mutual funds, which are one of the most diverse investment vehicles which you get if you want to go to invest in share market, where you can invest in equity, debt, and commodities. And there are different balance funds which will help you reach your goal at the same time manage your capital. So this was a short video on risk mitigating strategies. If you want to learn more about the types of investment risk, I will put the video in the I button. You can check it out. And if you have any comments regarding this, if you have any queries regarding this, you can feel free to reach on us on our number, or you can put your comments in the comment section. This is Atish signing out. Thank you.